I started renting this house in 2008. Could have bought the house at the time for like $110,000, $120,000. The landlord offered that, but I decided to rent it instead for $1,400 a month. Every year she said, "You want to buy me out?" And every year the price got a little bit higher. I was like, no, I don't know that it's going to be up. I'm going to wait for the bubble to pop again. And when I finally bought my first house, I didn't buy my first house until 2017. That was 41 years old. First house I bought, 41. Dumb. Should have bought every single time, but I was scared. If I would have bought that house that I ended up renting for 9 years, all the rent payments I paid would have paid off my mortgage, and I would have been able to sell it for about $200,000. Today, that house is worth about $400,000, and it would have been tax-free.
Welcome to this episode of the Hidden Money Podcast. Today, we're going to step in a time machine and just say, what would our younger selves do 10 years ago on the investment side? And a lot of this might be tax-driven, obviously, but there are some mistakes we've made, some things we haven't done that we should have. But what would we have done 10 years ago, knowing what we know today? And we're a little older, maybe a little wiser, definitely more grayer. But what would we have done?
Speak for yourself, grayer.
I am way gray.
You have zero? I see
no.
grays.
It's close up.
I was just looking at pictures. Becca was showing some old family photos, and we're showing our first beach time with Eli 7 years ago. 8 years ago, 7 or 8. No gray.
Clean shaven, too.
Clean shaven, yeah. Yeah.
It's taking a toll.
So I've grown up. I'm more mature. You, Sonny, you still got some time before you, but we've learned a lot together.
Yeah.
But no, I mean, and obviously we're going to have a tax bent to this, right? But, if I could go back 10 years and 20 years ago and tell myself, hey, think about this or do these things in investing, how much, I can't even imagine. I mean, besides the obvious, Kevin and I were just joking about this before. Well, 10 years ago, should have bought a bunch of Bitcoin and NVIDIA stock. I mean, that would have been nice. And gold coins at $300 an ounce when now they're $4,500, I think, today. But let's talk about the tax side of it and why it's important. Because what we're hoping, my father and I were just talking about this actually on my drive up here today. Some of the hardest, the best lessons I've learned, and he's learned in life, were some of the hardest, the most expensive, the most painful, the most complicated. But boy, were they good lessons. And I was like, well, Dad, why didn't you just tell me and help me learn without the pain, without the cost, without the lost money, without having to hire the lawyers to get out of things, without to get out of bad partnerships? Why didn't you just tell me? And my dad said, I did, Mike. You wouldn't listen.
I need to talk to your dad.
Oh, man. But anyways, if any of you guys are open to learning from what we wish we would have done as investors 10 or 20 years ago, this is episodes for you.
Yeah, and in times actually, they change, obviously. Like 10 years ago, I was in my mid-30s. So I didn't have the income at the time. I didn't have the risk tolerance to do a lot of things at that point either.
No risk tolerance.
That's zero. And so I was like, I'm just going to stash my money in a nice conservative mutual fund and spread that out, and everything will be fine. Now, there's some wisdom to that. I still do that. There's a part of my investment portfolio where I legit just allocate my investment over different mutual funds in different sectors, and it covers me. But now I'm also doing a little crypto. Now I'm doing some oil. Now we're buying some real estate. And real estate's always been one of my biggest profit drivers in the past. Well, being in North Texas, we're in the DFW area. DFW area is just, you couldn't lose in this market from 2010 to, there's been some losers, but the majority of your purchases and sales have appreciated in value in North Texas just because the people transplanting here.
They've all appreciated if you weren't forced to sell at a different time, right?
Yeah.
Like if you could hold on long enough and didn't have to sell in the downswings. And that's probably lesson one I would tell myself 10 years ago, 20 years ago, 25 years ago, but I'm not old.
Real estate is so nice.
I was scared to buy real estate. I kept thinking, well,
you're waiting for that bubble.
The dumbest thing. Yeah. So I moved to Texas 2005, 2006. And there was a bubble, but I didn't have the funds to buy a property or anything. But 2008 hit and we saw the bubble pop. DFW had only popped like by 15, 20% in most cases, but it popped. I saw that and that made me too scared to buy again. So I started renting this house in 2008. I could have bought the house at the time for like $110,000, $120,000. The landlord offered that, but I decided to rent it instead for $1,400 a month. Every year she said, "Do you want to buy me out?" And every year the price got a little bit higher. I was like, "No, I don't know that it's going to be up. I'm going to wait for the bubble to pop again." And when Becca and I bought my first house, I didn't buy my first house until 2017. That was 41 years old. First house I bought, 41. Dumb. Should have bought every single time, but I was scared. If I would have bought that house that I ended up renting for 9 years, all the rent payments I paid would have paid off my mortgage, and I would have been able to sell it for about $200,000. Today, that house is worth about $400,000, and it would have been tax-free. And a primary residence, if your rent expense is similar to your mortgage payment, buy. You should buy. I was too scared to. I wish I could go back and tell myself, and I can go back 3-4 times. There was a house when I was in college in Montana I almost bought, but I was too scared. In Bozeman, Montana, that house was $100,000. I just saw that house. I happened to look up on Zillow last year, and of course Bozeman, after Yellowstone has come out, that house sold for $900,000. And I was too scared. And I paid rent. I bought a trailer instead, and I didn't make any money. You don't make money on mobile homes unless you're renting them out to people. But anyways, that would be my number one lesson. And there's a tax bent to it too, right? Real estate investments. Now, if it's primary residence, your tax benefits, you get to deduct interest. You don't get to deduct rent if it's your primary residence. But you get to sell it tax-free. But if you're buying investment property, I would have bought more rentals. Let's talk about
mostly
the
tax-free. Yeah, Code Section 121 is what you're referring to. If you live in your primary residence for 2 of 5 years, you get to exclude $250,000 if you're single, $500,000 of gain if you're married. In this market, we've seen people pay tax on their primary residence because of the appreciation's been so high. But that's not a bad thing. That's a lot of equity and appreciation.
The first $500,000 was tax-free, so they paid a little tax on a couple $100,000 more, right? Yeah.
So, yeah, I was kind of in the same boat. I bought a house in 2008 when the bubble. There was something called the first-time home buyer credit for $8,000, and I put I think I put about $10,000 to $12,000 down. I put and that was me grinding. I was a senior, just a CPA, senior CPA, and I was starting a young family, and man, I had to grind to save that up, and I saved it up. Put it down, and then when I got my tax return, I had an $8,000 credit. I was like, the government just paid for my first house down payment. It was great. And we bought low, and then we sold it 6 years later. So that was a good investment. And real estate's always been one of those things where I'm like, man, I've always made good money in North Texas off real estate. It's always been profitable for me. Why didn't I do more?
And you seem to accidentally time every real estate buy and sell perfectly.
We'll see on this one, though.
I've always chosen to try it. You did. You timed it. You bought this home.
The tax law incentivized me.
No, this last home you're in, the home you're in now, and you got 3% mortgage or something. Yeah. This was right before interest went way up, and I was thinking you were crazy buying that home. And you got it at a really good deal compared to today's prices. Yeah. Don't try to time the market in real estate. That's another thing I would tell myself.
Or perfectly time it. There's good and bad times to buy and sell, but I think you were waiting for when you're watching stocks, you're watching the graph, you're like, when's the valley at the very bottom? That's when, because if you buy a little before or after, you might feel like you're getting ripped off, or you could have had a better deal,
Yeah, that's been a problem.
It's that feeling in you. You want the best deal humanly possible, no ands, ifs, or buts,
The only time I've timed any investment right was Tesla. Right after Doge came out, all the Tesla dealerships are getting burned because Elon Musk became public enemy number one. And I bought it at 217. And I hate myself for not buying a heck of a lot more, but that's my one big equity holding.
But you've learned, we both have on the real estate, we're buying a commercial property and we're going to use it for a trade or business. That's the same economic unit as our business. So those two are going to offset. So we're going to tax plan with a commercial property against our tax practice, which is growing our wealth. This property is going to go up in value. It's right in the heart of the Metroplex. It's satisfying a need of our business, and we're going to save taxes all in one. So we're kind of learning, but it took us a while to get to that stage because it's risk. and risk is hard. You take risks very easily in the business because you have the vision and you have the tolerance to say, hey, if we hire these people, then
we'll be able to save that many more taxes for people.
Yeah.
We'll get paid that much more. That's so easy for me to take that. That's not a risk to me.
And
That's
then we
obvious.
transition that risk to a different area of our business that may not have that goal of tax savings. It's just kind of like, hey, it's a property, we need it. Then that risk is more real to you, I feel, than that. So
yeah, we switched places on that, right? Like that's the first time you were like, Mike, why are you so risk adverse? It's always
usually
been
you're like,
the
let's
opposite.
go.
And I'm like, but we're not hiring a tax person. We need to hire
We could be
tax
growing
people.
the business so much more if we didn't buy this property. Yeah.
No, it was the right choice. And it was because of the lessons I've learned. So right now I only have one rental property, my primary, and now our office building. If I would have bought and all the chances and opportunities I have for real estate, I would have a lot more. I could have 5 rentals by now, easy. Couple short terms. Like when Becca and I first decided, all right, we're gonna do the short-term rental market, we got pre-qualified for like 2.6% interest on a nice big payment. And we made more than a few offers, but I underbid every single one and I lost out some of them by like 10 grand. If we would have had those, if I wouldn't have tried to time it and get the perfect price, oh my gosh, would we be sitting pretty? And the taxes we would have saved would have easily paid for the additional prices that I was afraid to pay for, right? And that's the last thing on real estate I want to mention is, yes, you get the primary home exclusion. If you're buying it for your business, your commercial property, there's that awesome depreciation if you're in the same economic unit. But even if you're a passive rental real estate investor, you get cash-free distribution, tax-free distributions, not cash-free. Sorry, cash-free distributions. Yeah, that sounds like
everyone wants those.
No one wants those. I don't want those. But you get tax-free distributions, and the tenant is paying your mortgage, so you can grow so much more. I didn't like the idea of debt leverage. You used to hate it. Talk about that in real estate, and then we'll get off real estate and start talking about other things.
Yeah, because there's some other things we want to go through.
A lot of
yeah, debt, it's kind of like, I was so anti-debt, Dave Ramsey kind of thing, and I was like, man, we're bootstrapping this business from the ground up. We're not using debt, which there's 100% wisdom in that. I always equate, and I've said this before in the podcast, where debt is dessert. It's okay every now and then. It's okay to leverage it, use it. You can accelerate the growth of your business. You can buy more investments with that. But too much of it, you get sick, you get overweight. It's just not healthy to have too much debt. So you want to make sure you're managing your debt, but I mean, we're taking debt on this. We wouldn't be able to cash flow a commercial property. If we were going to Dave Ramsey this commercial property, we would never buy one. But why would I ever save up a couple $1 million and buy a property? It makes no sense when I could pour that into the business.
Well, we make it smarter debt. We're getting fixed interest, right? Like we're paying a little bit higher points to get a fixed rate. We're not getting variable
for
because
10 years.
We've seen where that happens. Yeah.
And we have a low rate blocked in for 10 years. I know what my payment is every year.
And we know we can float it.
Yep.
Worst comes to worst, we know we can pay for it. So that's good debt. But so just an example. Let's say we saved $1 million up to buy $1 million property. Used $1 million cash, we saved up, we bought $1 million property, held onto it for 5 years, and sold it for $2 million. That'd be nice. 100% return on your income. 100%. Well, let's say we bought the same property with 20% down, $200,000 down. Got safe fixed debt. $200,000 down, get $1 million property. So you're using the bank's $800,000 to have that $1 million property. You're paying interest. 5 years later, you sell it for $2 million. You turn $200,000 into $2 million. That's 10x, not 1x, 10x. So
but you have to pay that debt down, but not that close.
Well, let's say you have a tenant that's paying it for you. Boom. Okay, so you didn't get the cash flow, but you still got 10x. We see that happen all the time with our clients. And I was a Dave Ramsey fan too. I still kind of am within reason, but like I used to listen to his show all the time and I get so excited. Like that's where I get when people say, how are you doing? I say, better than I deserve. That's Dave. But also the people that would just be so excited calling in and saying, I'm debt free. And he had like some kind of celebration buzzer thing. And that was exciting. So I like it. But as I saw client over client, the difference between our clients over the last 15 years that were making 8, 12% a year on their income in real estate, and others making 40, 50% over 10 years, in real estate, it had to do with debt. But then I also got to see the 2008 crash and then the 2021 inflation crash. And the people that got hurt and lost everything are the ones that got bad debt or overextended themselves. They didn't have rainy day fund to be able to pay it. Most of them are the ones that got interest, variable interest debt. And when interest went from 3% to 7 or 8%, suddenly you can't afford to keep that asset. And now you're selling in the worst real estate market. So if you're gonna buy real estate, I'm 100% believer. I know it disagrees with a lot of people, but 100% believer and preacher, get a fixed rate mortgage.
That's right. And spread that payment out if you can. That's what I think too. Cash flow today is very valuable for your business. So the other lesson I learned is not relying on other people's research to invest in or other people's experience to drive what you invest in. And we invested.
Or previous results. Like you always hear, hey, just because it's done this over the past 5 years.
It's going to do it again.
You don't think it's going to do it again.
Yeah.
It doesn't guarantee future results. Past results don't guarantee future results. It's hard to actually take that.
Yeah, and we had we lost our butt on one of our bigger investments too in 2020, 2021, somewhere in there. We had a bunch of clients that were investing into this oil and gas deal. We were seeing the K1s come to our clients for several years, and these are cash distributions. We know how much they put in, how much IDCs they were being allocated, how much depreciation. They're getting 2x their investment amount in loss, deductible loss, plus they're cash flowing like 20% a year on it.
More.
And so we were seeing these K1s for several years, and so we actually had a good year that year, sold a part of our practice, and we're like, yeah, let's just get some of this money into this fund. Well, we did. Did I do as much due diligence as I would say I do now? Heck no. What I saw future or past results, past reporting, and we knew the people who were putting on this deal, and so they were in our networks. We trusted these guys
because all of our network trusted these
because everyone else, and so we relied on our network, relied on our K1s that we saw coming into our clients.
We did not do our own due diligence.
We invested our actual money into this deal, and then I don't know how many months later.
4 months
probably
later?
Half a year.
Not even. We invested in December, and SEC
shut them down.
Came out in March, I think,
Ponzi
of that
scheme.
year.
So we invested our money in a dead-gum Ponzi scheme because we relied and didn't do our own homework. But that has trained us very well because we still invest in oil. It did not sour us. We took our licks for sure. We took one off the chin and we keep going.
Some serious due diligence.
But now, Mike, you've visited sites. You are digging deep into these deals to make sure that one, we can't guarantee profitability, but you're setting us up in these.
At least I know it's not a Ponzi scheme. At least I understand the business plan, and I've done a deep background on the operators.
Yes,
right?
on every operator we do business with.
And if we'd have done any of those things in the other investment,
it would have fished out.
It would have fished out. And what I should have listened to, my grandfather is a great man. He grew up in New York City during the Depression. Super, super poor family. His dad was an immigrant, and he bootstrapped himself up. And was a New York City firefighter, lieutenant, but he started investing in real estate and then in the market. And relatively speaking, he retired pretty darn wealthy. And he used to tell me, never invest in something you don't understand and never invest in something that sounds too good to be true. I understood the oil and gas thing that we invested in. It did sound too good to be true. Now, when I see too good to be true investments, I double, triple, quadruple check them. And I usually don't invest in them unless I absolutely understand it. That, however, don't invest in something you don't understand has prevented me from getting into cryptocurrency.
Because
it's all my grandfather's fault that I'm not in crypto. If I would have gotten into crypto 10 years ago, when everyone else was doing it, we could cash flow the next 20 hires that we need to make. Thanks a lot, Poppy.
Yeah, way to go. But hey,
but if I were to listen to him in the oil thing, we wouldn't have done it.
How much of those kind of meme coins have fallen off, though?
True.
Know? It's like Bitcoin has survived, but how much garbage has been created in lieu of Bitcoin in its wake that people invested in, like, oh, this is the next thing.
Yeah.
And I don't invest that way. But there's people that do, and some of it pays off. It's all risk tolerance, and we have to manage our risks. And I think you and I do a good job of that with our own personal finance. Like our business, I view is not as risky because I think we have a proven model. We have a need in the marketplace for what we do, and I think there's going to be a return.
We don't have great competition.
Yeah, and so money invested into our business, I don't view as risky as I originally did. But I still have some risky investments, some, that I'm going to hopefully hit home runs on. But I also have my mutual funds.
You should have bought gold and silver when I tried to convince you to do it. But anyways, now it's too late. Now you can't time it right. Another lesson, so I've been a tax strategist. I was a tax preparer, I'd say, until about 2008. And so I've been a tax strategist now for 18 years, where I'm really doing tax strategy and planning. And the power, just like we always hear about the power of compounding. We have episodes where you've talked about why you should start investing in your 401k when you're in your 20s, right? Because those dollars invested now will be hundreds of dollars by the time you retire. But tax-advantaged investing is another multiplier effect on compounding. And it's just so normal, I guess, typical. Did you know the number one profession that dies with the highest population or percentage that dies without having a will is attorneys? And the second one, CPAs, by the way. So practitioners tend not to follow their own advice. And I was helping clients make tax-advantaged investments that multiplies their ROI from 12% a year to 20% a year. That multiplies the compounding effect for the last 10 years. And I wasn't making tax-advantaged investments until 2019. Why was I not following my own advice? So tax-advantaged investments are uber important, and they don't all take material participation. There are passive ways to do it. Just a normal one is real estate syndications. Just make sure you do your due diligence, find the right operators, understand what the business plan is. But you invest, let's say it pays 8% distributions, or you have a choice of investing in a stock on the Dow or S&P 500 that's going to pay 8% dividends, right? Every year you get that 8% back from dividends, you're paying tax on that. Yep. Passive real estate run by a good operator, every year you get your 8% dividend or distribution, you're not paying tax on it because you have a passive activity loss carry forward. You add that up 5 years, 10 years, and look at the power of compounding, especially if you're reinvesting those distributions, you get 3 or 4 times as much money in a decade than you did from the stock. That's real estate. That's tax-advantaged investing. And I wish I would have been doing it all these years instead of the last 7 years.
Yeah, well, I think we didn't have the capital. You were investing in this business, right? So I wouldn't beat yourself up too bad.
I was still paying rent. I should have bought more houses.
Yeah. But that's why we learn.
I'm not going to beat myself up, but I want
we learn.
I want you, viewer, to learn from my lessons.
In 401k, it's a tax advantageous investment. 401k, you have those caps on it, but it could be pre-tax. You're going to pay tax on it in your retirement years. But a lot of tax planning is, hey, during my working years, and I've been stashing away into a 401k ever since I was 22. I've just always been taught, hey, you defer as much as you can into 401k, and then if you have capital left, you still invest that. But it's all pre-tax in my working years when my tax bracket's now high. And then when I'm retired, I'm going to come up with a plan there, or I'm going to just pull on my retirement at a lower rate then. Or if we have a big loss, let's say we buy this commercial property.
And we're able to
and we have
create
this
a big
huge
tax loss. Not cash loss, but tax loss.
A tax loss
Yes.
because of depreciation. I might be able to convert a bunch of my pre-tax money to Roth money and protect it from taxes in my retirement years and not pay tax on it, so I win on the front end and on the back end.
Yeah.
So retirement it can deplete some cash in the short term, but it's still tax advantageous in the fact that if it's pre-tax, you're not paying tax on that contribution. But Roths are still good, just because, I would prefer Roths, but.
And that's a lesson I would tell myself 26 years ago, year 2000, I got my first job with PwC where I could participate in a 401k. I did not maximize my contribution. So, and when I say that, you can always put a lot more away, but our employer, I can't remember what the match was. I think it was up to 5% or 4%. I didn't you should always max the employer contribution because it's free money that's going into your investment account. It's your money. Get that money from them. Otherwise, it's like paying too much taxes. You're leaving money that your employer would pay you. So you should always maximize that. So another lesson I learned. What else would you tell yourself? We're kind of running long here, as usual, because you talk too much.
Yeah, it's me.
Okay, it's me.
Yeah, I would say, man, don't be scared. I think that was you and I's combined hurdle in a lot of investing is we're scared because investing, there's risk. You have to be willing to lose. And that's what got me over the hump, because we invest a lot into oil now because of the tax benefits. And we didn't invest into oil with this forethought of a war in the Middle East and then Iran shutting down the strait, and then gas prices shooting up, and we're getting 30% ROI in a month. It's crazy. It's been good, but that's part of our portfolio. So there's risks in investing. It might not have
happened though, right?
Yeah.
But then we're diversifying too. So.
Even if oil prices tanked and oil and gas investment wasn't kicking off any ROI, you got commodities. I mean, that's going to shield you, and we have real estate. It's this holistic tax plan and this holistic picture that we're looking at now, and I'm okay doing some risky things in there because I have my safe stuff kind of always covering me.
And I'll tell you, investing in the stock market is taking risk, even in your 401k
risks.
and mutual funds.
You have zero control.
Zero. So there's risk there. We saw a lot of mutual funds investing in stuff because of the environmental friendliness and not the actual value provided to shareholders. Like there's risk, but you can mitigate your risk through diversification. Take risk, but mitigate it. Understand the risk you're taking. Do due diligence, but make investments and seriously consider tax-advantaged investments.
Oil is just it's so good. I mean, refer back to our prior podcast, but just think about oil and gas investing, and then I'll kind of wrap this up. Like if you took $100,000 and you bought $100,000 of Apple stock, you do not deduct your investment when you buy the stock. That's your basis, your $100,000. So now when you sell Apple stock, the difference between what you sell it for versus what you paid for it is your gain. When you invest in oil and gas and you invest $100,000 into oil and gas, you're deducting a good portion. This year, we're aiming for like 90% plus is our hope, that you deduct $90,000 against your W-2, against your business income. Your $100,000 you deduct. And where if you invested that 100 into stock, you're not going to deduct it. It's just your basis. It's just stuck there. So that is what a tax advantageous investment is.
And it's not just the ones we're mentioning, but let's do an example. Let's say you put this $100,000 in oil and gas, and it's got to be structured right to qualify for the benefit of being able to offset your active income with it. But you structure right, you put in $100,000, you get 75%, which is industry average. We're finding ways to improve it with our industry and our partners. But 75%, that means you get to deduct $75,000 off of your taxable income that year. What is that really doing? It's giving about, if you're in the top tax rate, just considering Fed tax, forget state tax. We get to do that in Texas because we don't pay state income tax. But if you happen to be in one of those other states that aren't on board yet with, constitutionalism and fairness and all that, and you pay income tax, you'll save a lot more. But basically, the IRS gives you $30,000 back for that $100,000 investment you just made. So you've got $100,000 investment, but you really only paid $70,000 out of pocket. The IRS put $30,000 in, and if it's a good investment, heck yeah. But be careful with oil and gas too, right? Less than 2 out of 10 on average retail oil and gas investments pay back your money and give you a positive return on investment.
But where there's risk, there's reward. And that's why if you look in the tax code, a lot of heavy risk things will have tax benefits tied to it. Because if these tax benefits weren't available to investors, how many people would take the 2 out of 10 risk? Not many, if at all. So that would stunt our domestic oil and gas production. So the actual Treasury is like, you know what we need to do? We need to incentivize our taxpayers to invest in this industry because otherwise no one's going to take this risk.
Sorry, I know we're trying to end this, but I just got to go in there because that explains why these incentives exist and are hidden in the tax code. These incentives exist because our country, it's not a socialist country, it's not purely capitalist, it's some kind of balance. But because taxes are such a potential big noose around our economy's neck, Our government has realized, hey, look, the way we can direct capital flow into things that our nation needs is through the tax code. It's a way of controlling us, kind of. But hey, accept it. The government's in charge of us right now, right? We gotta submit to the authority we're under. So when we had the bad gas lines and OPEC and the Iran stuff in the early 70s and mid to late 70s, it's because our country was producing a lot less oil than we were consuming, and we were kind of owned and controlled by the Middle East. And OPEC was saying, hey, sorry guys, Iran's saying no, so we're not gonna send you oil, or we're gonna ramp it up. And we had a crisis. So what did the government do? They're like, okay, we know we as a government can't fix this on our own, which is rare when the government actually admits that. I don't think they do that anymore,
Not
but
anymore.
back then,
Humility?
like,
No.
we can't fix this on our own, but we're gonna provide this incentive for people to produce oil and gas and take the risk here in the US. Now, we produce more oil and gas, more hydrocarbons than we consume. We're a net exporter. That was tax incentive. So we're not trying to teach people to cheat. We're trying to teach you guys, revolutionize the way you see taxes in the tax code by following those incentives hidden inside the tax code. It shouldn't be hidden. We're revealing it to you so that you can grow your net worth much faster and do your patriotic duty and make things like us energy independent.
If you had a mic, you could just drop it. We have lapels. You can just unclip and drop it,
I'm afraid if I do that, something will happen, or a producer will yell because it'll hurt her ears.
That's called the mic drop, but yeah. Mic drop.
Mic
drop. There you go. So thanks for joining us. Hopefully you found this entertaining. You can laugh at our fails, but yeah, don't be scared to invest, but learn from your mistakes. But if you haven't started, start now. There's no better time than now. Real estate should go up. Can't guarantee that, but if you buy a house today, it's going to go up. If you buy an investment today, hopefully it goes up. So no better time to start than now. Do your research. Make sure they're tax advantageous investments. Save on your taxes. Invest your money. And if you need help with that, please reach out to us. Go to revotaxpayer.com. You can go there. You can learn more information about us. And you can even schedule a free call with one of our team members and tell us more. We can tell you more about our firm, and you can tell us more about yourself, and then link you up with a personalized consult and see how we can actually serve you. So thank you for joining us this episode.
Yeah, please like and subscribe. And we're going to offer this one-time offer. It might be a continuing offer, but do please like and subscribe. That'll help us get our message out through these logarithms that work. I don't understand them. But for the best commentary on this episode, whether it's about tax advantage investments, whether it's lessons you've learned in investments, or my personal favorite, whether it's making fun of my partner Kevin here, the best commentary will receive a free tax consult with Kevin and myself at the same time. Solely subjective on what Kevin and I think about it. But man, if you do a good one with him, you got a free consult. Only one-time offer. So please do your comments. Thank you very much for being here. Thank you for listening to this episode. Revo Taxpayer Advocacy, LLC is not licensed or registered as a CPA firm with the Texas State Board of Public Accountancy. I'm a CPA, Kevin's a CPA. We have a lot of CPAs on staff that are licensed and held to the same standard. However, when we decided to be revolutionary and change our name to Revo Taxpayer Advocacy, the State Board would not allow that and let us remain licensed. They say we have to have one of our names in the firm for us to be licensed as a firm, and guess what? It's not us that's important. It's revolutionizing the way you feel about taxes and saving you money. We are advocates for you, so we were willing to drop our firm license, even though we're still individually licensed.